All righty.
Thanks, Andrew. Thanks for joining us. Really appreciate it. We look forward to this conversation. Andrew, please tell us about your experience and how you developed your interest in financial markets and what you're focusing on today, Andrew.
Oh, okay, sure. I guess it started pretty early for me. I'm in my 50s, but I first started in the markets actually to put trades on when I was 16. I used to get my dad to put these trades on. I didn't obviously have very much money when I was 16, and I used to go in there and ring and get dad to ring the broker and buy a stock at 1 cent, wait for ages, eventually get it at 1 cent, then wait for ages and sell it at 2 cents. The brokers used to be like, just buy the damn stock, Andrew. Actually, I remember my first really successful trade was with I think it was something like Western Gold or something, and the broker said that I'd get a good, honest run from this company. Anyway, so I put all my money, which was a few $1,000s, into this company, and about 3 days later, it went up 100%, and I sold it all at the top, and then it collapsed down. The funny thing was later that the directors wound up getting in trouble for lying to the exchange. and that taught me about how the stock market often works. Yeah, but anyway, so what I did, I kept trading for years. Eventually, I started to trade more in the US because there were more opportunities over there. It was just a bigger market. And I ended up knowing, compared to other people in Australia, a heck of a lot about trading in the US. So I thought, I'll write a book on it. So I wrote a 300-page book on how to trade in the US markets from Australia. And then I rang up Wiley, who are a major financial publisher, and said, look, I've got this idea for a book, for Australians to trade in the US. They said, oh, it sounds good. Send us out sort of the idea. I said, look, I'll just send you the whole book. So I sent them 300 pages of the book, and that ended up getting published. So that got published. I ended up using that as kind of my CV to get a job with one of Australia's largest full-service brokers at the time, with about 200 brokers across Australia, running about $15 billion. So I did that for about 10 years, doing macroeconomic analysis for them. Then I left there and I went to run a small boutique high net worth fund of about $120 million for a specialist firm in West Perth. I did that for a while, and then I came home one day and fell on the ground and had a stroke, almost died, and then spent 2 weeks in a coma, and then 3 months in intensive care. Since then, I've been doing some sort of mostly writing, consulting work, and trading my own account and learning to walk as well. So that gives you a brief background on sort of my experience in the market, I guess.
Incredible. Thanks, Andrew, for that. Appreciate the background. I'm going to dive straight in. I'm very interested in your views from a political and macroeconomic standpoint. You've got a wealth of knowledge of the financial markets, and you've done a lot of analysis for some of the biggest firms. Now, what do you perceive to be the biggest risks then from a political and macroeconomic standpoint?
Actually, I'm going to sound a bit like a tin hat sort of crazy person here, but the biggest risk, I guess, or the risks I see are what effectively is going to amount to a totalitarian fascist takeover by the WEF. Now, you think I'm joking and crazy, so before you come to that conclusion, which is very easy to come to, I would suggest that you go to the WEF website, read the entire website, look at the strategic partners that are involved in that organization, and look at the risks and the way they're setting up that organization to basically usurp the global democratic process. Now, that all sounds pretty wild until you realize it's a long way down the track. It's already been sort of put in place. A lot of these people have been put in to various government jobs and political positions where they're essentially now working for the WEF. That's why you begin to see very strong control in the media, some very strange decisions coming out of government. If you've been paying attention, you probably are scratching your head wondering why the heck are they doing this? Now, adding on to this would be, or part of this will be the introduction of central bank digital currency. Now, currently about 70% of the world's central banks are trialing this. Now you go, well, how bad can the central bank digital currency be? It means that you'll essentially be forced to use this currency, and they would know every transaction that you can make you make with this currency, and they'll also be able to block certain transactions that you make. So this is all part of the process. If you look at the other thing that I would traditionally be worried about in the market, and I have been in, I'll just give you a bit of background. In 2006, I was working for a major broker, and I wrote an article entitled "I'll Huff and I'll Puff and I'll Blow Your House Down," about a strange increase in the length of time it's taking to sell US properties, and also the US property linkages with the derivatives market. And of course, I think one of the directors actually wrote back to me and said, "You're paid to write about stocks. Stop writing about housing." And I went back and I said, "Well, I think housing is going to be very, very important to stocks." And he sort of gave me a hard time over it. Of course, 2 years we hit the global financial crisis, which was caused by the default of Lehman Brothers, mainly because of collateral debt obligation defaults in the housing sector in the US. So it all came true in about 2007, 2006. I'd entirely sold my portfolio out of the market, which is unusual for me. And so I didn't own any shares during the global financial crisis while everyone was losing money. That is a situation that is not yet fixed. In other words, the risk in the OTC derivatives market, or the counterparty risk, is still effectively, I'd describe it as unquantifiable risk. In other words, it's a structural risk in the banking system that still exists. If you think, well, that's all over, have a look at the Credit Suisse stock price for the last year. So all the way down in the couple of Swiss francs now. I think since Credit Suisse started, it's lost something like 89% of its value. Money's been flooding out of Credit Suisse. The reason that is that the market, or the stock market, and also the derivatives market, knows that risk or counterparty risk cannot be quantified within the banking sector. And therefore, if you have any signs that someone potentially might be in trouble, you get out very quickly. So again, don't think I'm crazy. Just review Credit Suisse at the moment and have a look at how they've been doing and their returns for shareholders over the last few years, and draw your own conclusions. But it's probably a little bit complex to go into the counterparty risk or the structure in the OTC derivatives market for your listeners. If you want to, I can try, but it is one of the most complicated markets. You really have to be an expert to understand what's going on in that market. But it is a fundamental underlying structural risk. Excuse me. I would say they're my main concerns at the moment.
So sort of having said that, then what kind of decisions are you making? You said in your own sort of portfolio, are you therefore reducing your equity exposure at the moment, or are you sort of sitting on the fence? But is this going to resolve?
I think it depends. It's like putting together a pattern. Excuse me. You see risks. So first of all, you would look and you would go, wow, look at the Credit Suisse, Credit Suisse stock price trading heavily down for the past year. Well, look at the number of people pulling money out of Credit Suisse. wow, look at all the traders that are running away from Credit Suisse, actually leaving employment there. Then you look at collateral or CDS, with credit default swaps market, and you see and you think, wow, look at that. Credit Suisse credit default swaps are spiking up, which is a sign of rising credit risk. So then you go, okay, well, that's quite a story. That means there's more risk in the global market because of the structure or structural risk in the banking sector. And the next thing you would look for, and this was a great tip-off in the lead up to the global financial crisis, was any type of problem in the interbank market, which is the banks dealing with other banks. And the biggest tip you got from say, in 2008, that the global financial crisis was about to happen, was a story in Bloomberg that said 30 European banks stopped dealing with each other in the overnight money market, which is the interbank market. And you knew that these guys who were right on the spot were terrified to do that. And that became a real problem. So how do I deal with that myself? I think, first of all, I'm very, very conservative with the market. When I was advising people dealing in the market, I'd sort of start all my conversations with, Mrs. Brown, have you paid off your house? And as she said, yes, of course, I paid off my house, and I've got $500,000 in the bank. And I said, okay, let's talk. But if Mrs. Brown said, no, the kids are still at school and I haven't paid off the house, I'd say, well, okay, go home, pay off the house, get the kids through school, and then come back and talk to me when you're over. So that's the first point. Don't be in the market unless you are in a position where even if you lost all the money you have in the market, it wouldn't negatively affect your lifestyle. So my first rule is never trade at a level that would damage your lifestyle or your kids' lifestyle. If you're trading at that level, you're trading way too much. So my second point is then dramatically reduce your position size when you're in periods of heightened risk. So definitely do that. So either stay away and manage your position size. This is really brings me on to one of my big bugbears in the market, where people go, blue chips are safe and speculative stocks are not safe. And the whole Australian superannuation system is set up like that. Sorry to tell you, but that is entirely wrong. Okay. The thing that makes a stock risky or not in the stock market is how much money do you have in it. In other words, if you have $100,000 and you have $80,000 of that money in BHP, and you have $1,000 of that money in speculative mining stock, the superannuation system says the speculative mining stock is risky and BHP is not risky because it's a big end blue chip stock, but it's actually the exact opposite. So adjust your position sizing, look at the amount of money you can lose, and don't assume that it's safe in blue chips. The other point I would say is don't get caught up in situations where things deteriorate. If things start to turn bad, I mean, we used to say the first profit downgrade is very seldom the last profit downgrade. If you hear it, hear a profit downgrade, probably 7 out of 10 times, just dump the stock and move out. If the story in the stock begins to deteriorate, or if management starts to do weird things, don't run around and hope or wait around and hope it gets better. Dump it, get out. You'll see things so much more clearly when you're back to neutral. And don't be worried about taking a loss. In actual fact, the only way you'll ever make money in the market, sounds contradictory, is to accept that sometimes you'll make a loss. Just have to play the percentages. If it starts to go against you, get out. But make sure you work on that sort of macro level of what's happening in the overall risk, what's happening in your lifestyle, how you can reduce that risk, and then trade from there. I mean, literally, I know a guy that made about $80 million out of the market from nothing. One of the best traders I've ever met. And you know how much he used to trade in stocks? He did trade only speculative stocks. Somewhere like his average position was about $5,000. Okay. And he would still do that after he'd made millions out of the market.
Wow.
You go in, buy, you know, $1,000, $5,000, and then how's the story going? Oh, is the story getting worse? Yeah, the story's getting worse. I don't like it. Sell out, get out. You haven't lost much. Go in, buy, you know, a couple of $1,000, go along for a while. The story's getting better. Oh, okay, look, this is improving. I might be right here. Double up, buy another 2,000, you know. Watch again. Is it still improving? You think, gee, this management really good, you know, or gee, this project's really shaping up, or gee, the iron ore price is starting to really climb. Double up again, you know, and keep pyramiding while it's in your favor. So it's all about risk management. If you see, it's what I'm talking to you about here is if you're going to survive in the market for long term, you must become an excellent risk manager. And all those things I've just mentioned are some of the things you need to do. Because I think you've got to be aware that you will never know everything about a stock or everything about a situation. Well, you know, you'll think, well, this stock's a great stock. I know everything about it. And then something like 9/11 will happen out of the blue, and suddenly you'll be way down on it. You know, you have to go, well, if something happens that I totally, a black swan event that I have no clue about, am I going to be wiped out? Never put yourself in a position where you can't come back later, because that's a really bad loss then. If you can't come back, if you lose, you know, 50% of your money, you then have to make 100% in the market to get back to even. And you have to be pretty talented to do that. You know, guys like Buffett, over some of the best traders in the world, average returns a year about 23%, sometimes less, and sometimes they're way behind the market, you know. So just think about risk all day long. And as you do that, you will learn more and more as well. And you'll become a better trader thinking that way.
Thanks
Also,
for that.
just one other thing I should mention is if you're trading in the speculative end of the market, don't go for small gains. Go, okay, what's the market cap in this market? Or what's the market cap in this stock? Oh, it's small. If they pull off whatever they're trying to do, if they get their mind going, how much will they earn? How much could the stock go up? Generally, you want to see, say, 100% downside chance if it all goes bad, and say 300% upside. Think about that. If you find a stock and you think, well, it's got 100% downside risk and 100% upside risk, don't worry about it. Just a neutral trade. So just walk away from those. So it's all about risk control. Anyway, sorry to cut you off there. I just had that final thought.
No, thank you. That's good advice. Thanks.
Thanks for that. Really appreciate it, Andrew. Can you kind of give us a bit of a rundown about the relationship Australia and China in at the moment? And can Australia break away from its reliance on China? And should Australia be doing more to maximize value from our resource-rich country, Andrew?
All right. Yeah. Understand, I don't want to sound like a crackhead again, but understand that a lot of the pressure getting about China is extremely negative because the Americans are pushing this anti-Russian, anti-China narrative at the moment in the media. The reason they're doing that is a whole different story. It's about protecting the petrodollar, which you can think of, I guess, like as the US dollar, and the Chinese and the Russians, the Saudis, and a few other countries are getting together and trying to develop a currency that would be potentially commodity backed, that would be a rival to the petrodollar. To understand the petrodollar, basically, in very simplistic terms, means you can, if you want to buy oil, you have to first buy US dollars and then use that US dollar to buy oil. So the US can literally create money out of thin air and then turn it into hard assets like crude oil or nickel, because it has control of the petrodollar. That's why it's protecting it. And that's why places like Russia and China are trying to break that hold that the US has got. So in terms of whether we should continue our contact with Russia, first thing is the negative press you hear about China is overemphasizing the bad side. Now, I'm in no way saying that China is a perfect state. It's a communist dictatorship, obviously, and it does some very bad things. But don't get caught up in all this negative press. China's around for a long time. It's our major trading partner. So what I would suggest for Australian companies is perhaps tap into this new US manufacturing revival that we are seeing for maybe 20% of your product distribution for export, and then continue this very strong association we've got with China. At least I would say that at the moment, unless things dramatically change. One way to check what's going on, you pick up the press and like there's apparently saying huge riots over COVID in China. It's not really true. I mean, if you look at some of the more legitimate press, there's about protests in about 8 cities in China. I think there's 160 Chinese cities with over 1 million people. So that puts us in perspective. But then if you go, well, I don't believe you, Andrew, you're just a Russian or Chinese stooge, then go to the Shanghai stock market or Shanghai stock market index and have a look at how is that doing at the moment. Then look at Hong Kong, then look at South Korea. How's that doing? They're all hardly reacting. So if China's falling apart, why are the traders in Shanghai, Korea, actually Singapore as well, and Taiwan as well, and Hong Kong also relaxed? Those guys know what's going on. They're not worried about it. So I think this will all die down in the future. I wouldn't get too caught up. It wouldn't dramatically change your strategy, your trading or export strategy, according to the press you're reading at the moment. Maybe just focus a little bit on somewhat of a revival of manufacturing in the US, to an extent, only about 20%, as I say, anyway, mate.
So when you talk about the petrodollar, what's your view then on a gold-backed currency, and whether we should be perhaps considering that more whether economies should be considering that a bit more seriously?
I used to be a real believer in gold. I sort of mentioned the gold stock I brought when I was 16. So it's not like, and of course, living in Western Australia, you're meant to love gold. And if I'm totally honest with you, I don't have a single gold stock at the moment. You can make a bullish case for it because you can say, well, if there's a problem with the US dollar, people may eventually go into gold. But, and the liquidity of the gold market is very small compared to about $4 trillion a day of liquidity in the currency market. So theoretically, there's a lot of leverage. Am I going for it? I've got to be honest and say, no, I'm not. Where have I been finding my currency inflation hedge? Not in gold. In the last year, I've been trading coal and I've been trading lithium as the two areas that are in inflation hedge for me. They're both, commodities, obviously, and let's face it, they're blitz gold as a return. So I think would I put people in gold? I used to say for the people that would then go, yeah, but it's gold, Anna, it's gold. I'd say, all right, well maybe put 2 or 3% of your portfolio into it, but keep it on the watch list, keep an eye on it. But there's something wrong with it. I mean, you've got rapid inflation. All right, it's coming down a little bit at the moment, but it'll probably stay high for quite a long time, or relatively high for quite a long time. You've got a war. You've got some of the most massive, aggressive macro risks I've ever seen in like a lifetime of trading in the markets, and some of the weirdest risks that, if you talk about them, make you seem like a nutcase, and yet gold is hardly doing anything. That's usually a sign that things are not good in the market when it's meant to be going up and it doesn't. So I'm not saying that tomorrow it couldn't change. It's a relatively small market compared to the currency market, but at the moment I'm not that excited by it. Some people practically treat it like a religion, but I don't.
No, fair enough, and I agree with that. It hasn't really responded as you would expect, so it's been surprising to me.
No, and I think, mate, especially when you compare it to, say, trading lithium, coal, or LNG in the past year.
Yeah.
Which have been huge, huge winners. Literally hundreds of percent. I think lithium's up about 400%. LNG's down a little bit now, but still up on the year. Oil is an interesting one. I think you've got to say, well, Yeah, theoretically, because reserves are getting low in the US, it could be stronger because of the war in Europe. But I've just got this overlay of whether the US goes into a recession and dampens oil demand. So I've sold all my oil exposure. I've sold all my coal exposure. In fact, I did well out of coal. I sold it almost at the absolute peak. So, that was lucky. Am I going to go back in? No, not yet. Not unless it gets really pounded for some reason and down and turns. So that's how I feel about gold and commodities at the moment.
Do you expect the US to go into recession, Andrew? And also Australia?
If you look at inverted yield curves, basically, yes. I mean, 2 negative quarters of GDP growth is theoretically a recession. The economic management of the US is trying to think of a word for it, but all I can think of is terrifying. So let's just say it's the US economic management and government management is interesting at the moment, and that makes it very risky. And I think there's quite a strong possibility that we'll go into a slowdown. Probably in the US, definitely in Europe, definitely in the UK. I think Australia will go better than people think because at the moment, because it's strong commodity exposure. And that's not saying that the management here in terms of government or the RBA is any better. It's not. But just at the moment, we're kind of the lucky country. We've got some good exposures to commodities, and that's what you want at the moment.
Another interest rates have gone up. Yeah,
just before I say that,
yeah.
Be aware that in the short term, because of this recession risk, commodities could track down for a while and then perhaps turn around if things strengthen up later. So I'm not saying it's time to go long commodities. Time to go long commodities was about 8 months ago to a year ago. So that trade's kind of been a bit missed by now. Anyway, go on, mate.
Thanks, Andrew. I know the interest rates have gone up sharply in a short period of time. What risk is that actually going to play into the market? Do you see any major risk in Australia with the rates going up so high within a short period of time?
I was kind of lucky with the rates. I didn't think the central banks would have the guts to push them too hard, too fast, enough to really hit inflation and therefore slow the economy, which actually was lucky at the beginning of the year. They kept me trading pretty heavily in coal and lithium exposures and things like that, because I didn't think they were going to kill the market that strongly. And sure, they put them up a little bit in percentage terms. Based on history, though, it's still very, very low. Now, if you look at the last Fed announcement, they seem to be backing off. They're indicating that they will slow the pace of increasing rates, and that they may even be moving towards a pause in rates, which is actually really, given where inflation still is a really a very soft stance on being aggressive inflation. So am I worried about that? No, not really. No, I don't think they're going to overcook the market. I think they're being pretty sensitive to it at the moment. Maybe too sensitive. I don't know. Really, if we go back to Australia, when the debt to household income was about 65%, that's when the RBA should have been lifting rates, not aggressively, but starting to push them up to hold it about there. They didn't. Now they've got debt to household income around the 200%. Now that means that the average sort of household income or earner in Australia with a house is under financial pressure, 65% is about the historic norm. So for me, if I was running the RBA, I'd be when it got past 65%, I would have been saying to people, well, yeah, I think this is time when we need to just put a little jam on the brakes, keep it around this 65%. So the RBA mucked it up years ago. The Fed mucked it up years ago, and you're sort of paying the price with inflation now and risk. Yeah.
Thanks,
And
Andrew.
I'm
No
interested, sort of go back to your view on relative strength of the Australian economy, sort of against some of either the US, etc. And obviously the fact that we're a commodity-rich country is driving that. What's your view on an appropriate energy mix and how Australia can tap into that? So, renewables versus fossil versus nuclear.
Are you saying for the country or for the investor?
I think for
individual investor?
Australia, and and how we play into that sort of overall thematic, and then I just generally as well, how the globe is transitioning. What's your view on if it's an appropriate take?
All right.
So,
Well, I don't think I should stop sounding like a nutcase here, so I'll just keep going. Hey, mate. Adjusting the climate to your liking by adjusting CO2 levels is not something I believe in. Okay. Now I can go into all sorts of reasons why that is, but I don't really want to get into that argument. If you believe that, then your positioning in energy is very different to someone who thinks that you can adjust the climate to what you want by, reducing fossil fuel use. I don't know, by anything else, brushing your teeth or praying to witches. I don't know. Believe whatever you like. I'm not going to argue with you. What I believe is, so if it was up to me, I'd just keep going with coal. I would then run a renewable energy development kind of program alongside my existing coal and oil and diesel programs or power supply. So I had secure energy supply at the same time as I was developing a better renewable supply, but giving the world and Australia time to develop what may in the future be a technological advance that makes those renewable industries viable. There's two reasons why they're not viable at the moment. Actually, the first one for global is there's just simply not enough minerals in the world to replace fossil fuels with renewables. You just can't produce that kind of enough copper and zinc and nickel, lithium to do that. I mean, I think the last figure was something like, I saw something out of Oxford University, was something like you need to spend $7 trillion a year. 7 trillion. Now people go, oh yeah, $1 trillion, that can't be that much. Well, a trillion seconds, if you went back 1 trillion seconds, you would be talking right now with a Neanderthal, not with an Andrew Quin, right? That's that's how long 1 trillion seconds is. And that gives you an idea of $1 trillion a year, to develop this. It's just ludicrous. I'm not saying you don't want to reduce pollution. No one is out there going, let's increase pollution. Yeah, that's a great idea. No, that's a stupid idea. But you just don't have the technology there at the moment. And you go, well, no, you're wrong. My rooftop solar is great. Yeah, it is in some circumstances, in very limited circumstances. If you're lucky, some renewables works really well. I've got solar on my roof. I was doing the right thing. I think I paid about $7,000 for it. Literally 6 months later, my street got hit by lightning and wiped it out entirely. I never bothered to get it fixed. There's a million things that can go wrong in solar and wind energy. Sometimes it makes money and makes energy, but an awful lot of time it doesn't. And if you don't believe me, go and buy one of those $400 pumps for your pond, solar pumps for your pond. Stick it on your roof and you will see that the water gets pumped when the sun is 25 degrees, exactly in line with the solar panel. And as soon as it's not, the whole thing shuts down. It's the same with these big projects. I think the people that might really make money, though, in the renewables industry are the promoters of wind and solar farms, packaging together and selling it to suckers, basically. That could be a lucrative business if you have zero ethics. And believe me, a lot of people in the financial market and in the media and in the government have zero ethics. So you have to be careful. but don't take my word for it. Go ahead and do what you like, But so in terms of the mix, I'd run that joint. I mean, that's not that. I'm amazed that they're not doing that. That's a normal way you transfer from one computer system to another. You run them two together because if the new one doesn't work, you're still operating on your back computer. So, and then once the new one starts working and you can safely change over, you change over then. That's how they should be doing the energy transition over 40 years, not this ridiculous sort of, let's do it next week. If you want to do that, you wind up like Europe, which is in all sorts of trouble with the energy. It's going to be for years, and don't fall for the falsehood that their problem is due to the Russians and the war in Ukraine. It is not. If you want to prove that to yourself, go to the UK oil production in the North Sea graph for the last 30 years and have a look at that. And then go and look at UK coal production for the last actually, I think from about the 1890s. Have a look at that. Both those graphs are plunging down. In other words, they've caused their own energy crisis. That's why I don't feel sorry for them. It's natural selection. If you're stupid, you get edited out. Sounds a bit hard, but that's the reality we are with energy policy these days, Now, as I say, don't take my word for any of it. Go and do your own research on it and have a look and see why they haven't got any energy. They haven't got any energy because they haven't been producing any energy. Fossil fuel energy for over 100 years, it's been tracking down. I mean, if you suddenly stop growing food and then, over years and years, and then are starving to death after all these years, have you done the right thing or are you just stupid? I mean, make up your own mind. It's a controversial subject, but often in the market, you have to sit back and go, okay, well, at what point are people going to come around to realizing what the truth is? Truth almost always wins in the end. It just can sometimes take a long time. As we used to say, the market can stay irrational longer than you can stay solvent. So you have to be careful in these cases.
Thanks, Andrew.
No worries.
Dan, you want to ask the last question? Yep.
Sure. So we do ask all of our guests this. It's you keep an open mind, so it doesn't have to be about the subject matter of today. But what is one thing that you're currently really excited about, and what's one thing that frightens you?
Okay, I think we probably already mentioned the OTC frightens me. The WEF really frightens me. Not so much for myself, but for my kids' future. In fact, I think this whole thing depends very much on what's in the best interest for your kids. I mean, they're out there playing, they don't know what's going on. So it's really up to us adults to go, no, I don't want this for my kids' future, and it needs to be stopped. And in order to do that, you're going to have to take on some of the biggest companies in the world. But if you have kids, that's what you need to do. What am I excited about? Pretty excited about every day, mate.
Right.
I've been building on to my house. Got a great dog. I've got great kids. Doing okay in the market. So I guess overall, I'm pretty excited. While I sound a bit negative on some things, I think I just have to be realistic about some things. I'm still excited about EVs. That's why I've been investing so heavily in lithium. Also, Western Australia is the biggest lithium producer in the world. So it's good to be into something that's sort of all around you. But I still think that's an exciting development. I like them. That's very exciting. I mean, after a downturn, I'm still perhaps excited about commodities and the outlook for long-term outlook for commodities. I think they certainly excite me. I think that's got a good potential. And, I keep up with most sort of tech changes and things, and, periodically they come through, and some of those are very exciting. So there's reasons for optimism, but, I'd say that you can't just let freedom keep going and not fight to keep freedom. As you guys were out to dinner the other night, we're really talking about that,
Yes.
So you guys will understand that. I mean, you can't leave freedom just to get on by itself. You have to fight to keep it. Otherwise, you'll end up losing it. So, I'm excited with the growing sign that people will fight for their freedom in future as well.
Thanks, Andrew. Thanks for your time. Really appreciate it. And we hope to have you back on our podcast probably in the new year to talk about markets and stocks. And thank you so much for your time today.
No problem. Anytime, mate.
Thank you.
Thank you.
Okay.